Welcome to WealthRise Stories, where clarity meets knowledge, and knowledge becomes financial power.
Welcome back to the channel where we break down timeless ideas and extract real-world wisdom from classic books, especially in the world of finance. Today, we're not just diving into the content of a book. We're also confronting one of the toughest questions out there, a raw truth that very few people dare to face when they first step into the stock market. And I believe this is the kind of question that, if you're brave enough to face it head-on, could mark the beginning of an entirely different financial journey for you. Before we turn the very first page together, I want you to take a moment of stillness and sit with a single sentence. A sentence that carved itself into my memory, and one that has haunted countless people who have ever entered this arena filled with opportunity and landmines. In the stock market, money moves from the pockets of the impatient to the pockets of the patient. But before that money settles anywhere, it usually passes through a brutal storm, a harsh journey where dreams of wealth can turn to ashes in a heartbeat, and savings accumulated over years can vanish without a trace. Sounds pessimistic, doesn't it? But that's the uncomfortable reality, one that most beginners simply don't want to acknowledge. All of us chasing financial freedom often get hypnotized by stories of overnight wealth, by the parabolic charts of superstar stocks. Think about those almost vertical price curves of Tesla or Nvidia during their golden years, or even the soaring runs of Apple or Amazon in their breakout moments. Those charts paint such a sweet picture of prosperity, of a bright future where money worries disappear. We look at them with hopeful eyes, fully believing we could be part of that success story. We dream of huge gains, doubling or tripling an account in a matter of months. That excitement is real, and it pushes us to act sometimes recklessly. But then, reality often slaps us across the face. None of us can forget those devastating crashes, the charts plunging straight down, as if the floor collapsed beneath them, wiping out years of gains in weeks. The dot-com bubble erased fortunes overnight. The 2008 financial crisis shook the entire global economy. More recently, we saw the Luna UST collapse, or those violent flash crashes where prices fell apart in hours. And every time we see those terrifying zigzag plunges, many of us feel our stomach drop, our heart race, or even fall into complete panic. And so, somewhere between these two emotional extremes, euphoria at the top and terror at the bottom, one huge question, a million-dollar question, hangs over the heads of 99% of people in the market. Yet almost nobody confronts it honestly. A question that, if answered truthfully, could become the biggest turning point in your entire investing life. It's a question we must ask ourselves. Is stock speculation, when you strip away all the fancy language, really just gambling with a nicer name? I know those words sting, don't they? They can even feel insulting. Most of us, when we talk about investing, want to present a clean, respectable, intellectual picture, deep, fundamental analysis, careful valuation, long-term conviction, becoming a disciplined Buffett-style value investor. We definitely don't want to be seen as speculators because that word carries a negative weight: recklessness, blind luck, irresponsibility, even unethical behavior. It conjures images of impulsive traders chasing rumors, making lightning-fast bets, hoping to get rich without real effort or real knowledge. Even in investing forums, finance courses, or communities, people proudly declare, "I'm an investor, not a speculator." They want to distance themselves from the image of gamblers who rely on luck. We reassure ourselves that we're the serious ones, that we have a method, a strategy, a system. But let's be honest with ourselves one more time. How many times have you bought a stock simply because it was hot and going up? Maybe even a meme stock exploding on social media. How many times have you entered a trade based on a reliable source, or exited one because of some technical indicator you barely understood? How many times have you felt incredibly lucky after a big win, and then incredibly cursed after a heavy loss, wondering Why me? If any of that sounds familiar, even just once, you're not alone. And that's exactly when we must confront a very uncomfortable truth. The line between methodical speculation and pure gambling is far thinner than most people think. And often we are speculating without knowing it. Or worse, gambling while convincing ourselves that we're investors making scientific decisions. This denial is the reason why 99% of people never answer the million-dollar question. And as a result, they stay trapped in the endless cycle of hope and disappointment, quick gains and painful losses. So the real question is there a way out of this cycle of randomness? Is there a path, a method that turns speculation from blind luck into a controlled science, where you don't rely on fortune but on discipline, clear strategy, and real understanding? Is it possible to read the market, understand the flow of money, and make decisions based on logic instead of emotion? Surprisingly, the answer to all of that is hidden inside a book written many decades ago, a classic that millions overlooked or misunderstood. A book with a bold, unapologetic title that challenges everything people assume about finance: Successful Stock Speculation. The title says it all, doesn't it? It doesn't avoid the word speculation. It doesn't dress it up as something nobler. It accepts speculation as it is, and more importantly, it declares that speculation can succeed, that it can become an art, a precise science, if you approach it the right way. This book does not promise to make you rich overnight. It doesn't say the market is easy or risk-free, but it does promise to give you tools, timeless principles, and deep insight that can turn randomness into advantage, turn vague feelings into calculated, logical decisions. It shows you that behind those parabolic climbs and catastrophic crashes, not everything is pure chaos. There are patterns. There are recurring behaviors. There are strategies you can study, refine, and apply with discipline. So if you've ever wondered where the line truly lies between speculation and gambling, if you're searching for a method to control risk while maximizing return without relying solely on luck, if you want to turn speculation into a real skill, you're in the right place. In the next parts of this video, we're going to open Successful Stock Speculation together and explore its hidden insights step by step. We'll see how a decades-old classic answers the very million-dollar question that 99% of market participants still ignore. Can speculation truly become a controllable science? Or is it forever a game of chance, ruled by fate? Let's find out together. This journey is going to be worth it. You know, there are certain stories and turning points in life that, whether we like it or not, we have to look back on to really see what we've been through and, more importantly, what we've actually learned. Today we're going to start a journey like that. A journey that might sting a little at the beginning, but I truly believe it will bring you insights that go far beyond any numbers on a screen. The title of this section says it all: I lost everything to learn this. And to understand what this really is, we need to talk about a book and a very personal story of mine. The book I want to introduce today, and the one that will be the backbone of this video series, is called Successful Stock Speculation by J.J. Butler. At first glance, the title sounds a bit academic, a bit dry, right? It even feels outdated since it was written a long time ago, back when the stock market was still in its infancy. No internet. No candlestick charts flashing red and green on the smartphone in your hand like we have today. But don't let the old school cover fool you. In my opinion, the true power of this book doesn't lie in some specific tricks or secret hacks. It lies in the timeless principles about psychology, discipline, and how we think when we're face to face with uncertainty. Butler laid the groundwork for understanding that the market isn't just numbers dancing on a screen. It's a mirror reflecting human psychology, fear, greed, confusion, and yes, blind faith. Speaking of blind faith, slight pause, soft sigh, I have a story. A story that even now sends a hot flush down my spine whenever I think about it. It was a few years ago, back when I was a lot more naive about the market. At that time, I had a small pile of savings. Nothing crazy by Wall Street standards, but to me, it was everything my hard-earned money after months and months of grinding. I heard a tip from a friend who heard it from someone else about a stock that was about to take off. It sounded so tempting, like standing in front of a once-in-a-lifetime chance to get rich fast. My mindset back then was, why not take a shot? I'm young. If I lose, I'll just make it back. So with a hot head and a little too much confidence that I could jump in and jump out at the perfect moment, I decided to go all in. I poured almost my entire savings into that one stock with this unrealistic fantasy of a massive profit in just a few weeks. Day one, the stock went up. I was thrilled. I felt like a genius. Day two, it ticked up a bit more. I was floating like I was standing on top of the world. Then day three came, and everything flipped. The stock started to drop. Slowly at first, then faster, and then it just fell off a cliff. I panicked. My eyes were glued to the screen, my heart pounding in my chest. I kept trying to find a reason, an explanation, some kind of signal I could cling to, but there was nothing. Just the terrifying silence of the market and a sea of red numbers growing bigger by the minute. That feeling of helplessness, of watching years of effort evaporate right in front of you, little by little. It's hard to put into words. I tried to comfort myself. It'll bounce back. This is just a small correction. But deep down I knew. I had messed up. Completely. I had wiped myself out, literally. It was an expensive lesson. A scar that still sits there etched into my journey. That feeling, the loss, not just of money, but of confidence in myself, in my ability to make decisions, it haunted me for a long time. And from that deep hole of failure, I started searching. Not for new tips, but for fundamentals. I wanted to understand why I made that mistake, why so many others blow up the same way, and how to stop repeating it. That's when I found, or more accurately, was reintroduced to classic books like Butler's. You see, this book isn't a get-rich-quick formula. It doesn't promise to turn you into a millionaire overnight. In fact, it goes directly against a lot of the flashy promises you see everywhere today. My goal with this series is to humanize the principles in the book. Meaning, we're not just going to read dry theories. We're going to reflect on them, dissect them, and turn market lessons into life lessons, into personal rules for how we make decisions, how we face failure, how we handle fear. We're going to explore whether these principles about discipline, emotional control, patience, and self-awareness, the very things Butler wrote about over a century ago, still hold up in our hyper-volatile world today. I believe they do. And I believe the lesson of losing everything isn't just my story. It's a wake-up call for anyone standing at the edge of big decisions, whether in finance or any other area of life. And on that note, I also want to make a very important disclaimer. Everything I share in this series, including my breakdowns of successful stock speculation and my personal stories, is for educational purposes and to share my personal perspective. It is not financial advice. The market always carries risk, and every investment decision is your own responsibility. I strongly encourage you to always do your own research. Dig deep and seek professional advice before making any financial decision. Our goal here is to learn to reflect and to grow our thinking, not to chase some magic golden key to instant wealth. So that's where this journey I lost everything to learn this officially begins. I truly hope you'll walk this path with me so that together we can uncover the things that really matter, the things we may have been missing in the rush of everyday life. Let's begin. We've already laid some solid groundwork together. But trust me on this, if charts are your map, then psychology is the compass that keeps you oriented on the vast ocean of the market. And that's not just a nice-sounding quote. I've seen it with my own eyes, and chances are you felt it too. are those moments when flawless technical analysis becomes completely useless because of a single emotional tremor. That's exactly why today we're going deep into Chapter 1, Warrior Psychology. Your biggest enemy is inside you, from successful stock speculation. Sounds dramatic, right? Reality is even more dramatic. Our goal isn't just to analyze psychological factors, but to help you truly see that learning to control your emotions, the two powerful generals called greed and fear, is far more important than how many support and resistance lines you can draw on a chart. This is the foundation, the backbone of every successful speculation decision. Picture this: you're standing in the middle of a battlefield. But the enemy isn't the army in front of you. It's the voices echoing inside your own head. In the stock market, the two loudest, strongest voices that drive most of your decisions are greed and fear. Greed shows up when you see a stock going vertical and a voice keeps whispering, "Buy it now. This is a once-in-a-lifetime opportunity. If I don't get in, I'll miss everything." It pushes you to ignore your own analysis, blow past your risk limits, and take positions that are way too big, way too dangerous, all in the name of getting rich fast. You end up chasing at the top, convincing yourself that this time is different, that the rally will never end. That itchy feeling in your fingers, that buzzing in your head, that's greed whispering in your ear. On the flip side, when the market tanks and your account starts turning red, a cold wave washes over you. That's fear. It screams, "Sell, get out now before you lose everything. Dump it before it all collapses." Fear drives you to panic sell at the bottom, to cut losses in chaos, only to watch the market recover weeks later while you sit there with nothing but regret. This is the vicious cycle so many people fall into: buying at the top because of greed, selling at the bottom because of fear. I'm willing to bet that every single one of us, whether a rookie or a veteran, has tasted the bitter flavor of that emotional spiral. So how do we break free? The first step, and the most crucial one, is identifying and managing your own biases. The market doesn't have emotions. People do. And those emotions distort the way we interpret information. Have you heard of confirmation bias? That's our tendency to only look for, listen to, and believe information that supports what we already think, while ignoring or downplaying anything that contradicts it. If you're holding a stock and you want it to go up, you'll read every bullish article, watch every bullish video, and skip over all the warnings. You build yourself a little information bubble, lose objectivity, and drift further from reality. Then we have FOMO, fear of missing out. This is one of the most dangerous enemies for new traders and investors. When you see friends bragging about profits or a stock blowing up all over social media and forums, you start to feel like you're being left behind. That feeling pushes you to jump in at any price, even if your analysis isn't complete or, worse, goes against your own risk rules. I've seen people buy right at the peak just because everyone else was making money, and I didn't want to be the only one missing out. That's FOMO pulling your strings. So how do we fight back? First, honestly question yourself. Before every decision, ask, am I doing this based on objective data or on emotion? Write down at least 3 objective reasons to buy, sell, and 3 reasons not to buy, sell. Second, actively look for opposing views. Read bearish analyses on the stock you're holding. Listen to people who disagree with you. This helps you see a fuller picture and stay more objective. Third, pause. When you feel emotion spiking, whether extreme excitement or deep fear, don't make a decision on the spot. Step away from the screen. Grab a drink, go for a short walk, take a few deep breaths. Give your brain time to cool down so you can think rationally again. To win on this psychological battlefield, you need to build a steel rule book for your trading mindset. This isn't some complicated strategy, but a set of disciplined principles for your own inner world rules that keep you grounded when your emotions want to take over. That rule book should include: 1. Clearly define your entry, exit, and stop loss before you enter any trade. Then stick to them with iron discipline, no matter how great or terrible the market looks in the moment. 2. Set a maximum loss per trade and for your overall account. For example, Never let a single trade lose more than 2% of your account. And never let your account drop more than 10% in a month. 3. Don't trade when you're emotionally compromised, angry, frustrated, overly excited, or exhausted. Take a break. The market will still be there tomorrow. 4. Keep a trading journal. Write down why you bought or sold, how you felt at the time, and what the result was. This helps you learn from your own wins and mistakes. 5. Don't follow the crowd blindly. Always have your own reasoning and analysis. The crowd is often wrong. The hard part isn't writing these rules. It's following them no matter how wild the market gets. But that's the secret to becoming a successful speculator. To illustrate the power of a cool head, I want to share a little parable with you. Once upon a time, in a small town on the east coast of the United States, there was an old fisherman named Mr. Carlson. His white hair and calm eyes had seen more Atlantic storms than anyone could count. While the younger fishermen would rush out to sea any time they heard rumors of a massive school of fish, they often ran into sudden trouble, and some days came back with empty nets. They would hurry out after the latest gossip at the local dockside bar, then rush back to shore the moment a small, dark cloud appeared on the horizon. Mr. Carlson was different. He had an old, worn notebook where he carefully recorded tides, wind directions, weather patterns over the years, and even the behavior of different species of fish by season. He set non-negotiable rules for every trip. Never go out when the wind exceeded about 25 knots. Never haul more than his boat could safely carry. And always stock enough food and water for extended days at sea. When the greedy waves of rumor about a giant school of fish crashed through town, Mr. Carlson would simply smile, check his compass and his charts, and stay put if conditions weren't right. He never rushed out to sea just because everyone else was hyped. When a financial storm hit the fishing industry, pushing the value of boats to record lows and triggering a wave of panic, selling many young fishermen dumped their boats and gear out of fear. But not Mr. Carlson. He calmly opened his notebook, compared past patterns with what was happening, and began buying good boats at unbelievably cheap prices from those who were terrified. When the industry recovered, not only were his boats intact, they were worth far more than before. The younger fisherman asked him, "Mr. Carlson, why didn't you panic like we did when the storm came? And why didn't you rush out when there were rumors of huge schools of fish?" He smiled gently and replied, "The ocean will always have stormy days and sunny days. A fisherman's strength isn't about who rows the fastest or who catches the most fish in a single day. It lies in consistency, discipline, and a cool head that sticks to his chart, knowing when to go out and when to stay on shore, and not letting the waves of greed or fear carry him away." Mr. Carlson's story is a powerful reminder for all of us. In the world of speculation, it's not the most complex analysis or the fanciest strategy that wins. It's your ability to control yourself, to keep your mind steady through every storm that becomes the true key to lasting success. Your biggest enemy is not the market. It's you, your emotions, and your biases. Start your journey of self-discovery today. Learn to recognize greed and fear within yourself. Build your own steel rule book for trading psychology and follow it relentlessly. Because the very first and most important victory in the market is the victory over yourself. Thank you for sticking with me through this first chapter. I hope these insights on warrior psychology become valuable gear in your toolkit. Remember, a cool head and a steady heart are the most precious assets you can carry into the battlefield of speculation. In the next chapter, we'll dive into Chapter 2, Reading the Market, the Art of Fundamental Analysis, where we'll learn how to evaluate the intrinsic value of a business, looking beyond just the price chart to understand the real story behind the numbers. Don't miss it. Hello there, and welcome back to our series on the classic book, Successful Stock Speculation. If in the previous chapter we laid the foundation for how speculation works and the essential mindset behind it, then today we're going to dive deeper into one of the golden principles, a philosophy that once you truly absorb it, will make your investing journey a lot less painful. That principle is this: reading the market. Don't fight the tide. You know, the financial market has always felt to me like a vast ocean. It has powerful currents, hidden undercurrents, and tides that rise and fall without pause. If you were a sailor, would you choose to row against a raging current? Or would you use the strength of that current to take you farther faster and with less effort? The answer is obvious, right? Speculation is exactly the same. The core principle we're exploring today is identifying the market's overall trend and moving with it, not trying to swim against it. 1. The trend is your friend. There's a famous saying in the investing world: the trend is your friend. Sounds simple enough, but truly understanding it and applying it is an art. I still remember my early days in the market. I was constantly drawn to those contrarian hero stories, the dramatic plays of buying at the bottom and selling at the top. I thought I had to be the smartest, the quickest, the one who spotted hidden gems no one else saw. But the market taught me a harsh lesson. Trying to go against the overall market trend is financial suicide. Why? Because a trend is the collective force of millions of participants, their decisions, their emotions, their expectations. It's not random. And it's not something you or I can easily bend. When you go with the trend, you're giving yourself a statistical advantage. You're moving with the majority, not against the entire world. It's like swimming with the current. You don't have to be the strongest swimmer, but you'll still travel much farther than the person trying to fight the flow. 2. Recognizing a bull market versus a bear market. So how do we figure out where the tide is flowing? There are 2 major states of the market that every speculator must understand by heart. Bull market. Picture a bull thrusting its horns upward. That's the symbol of a rising market. Typical signs include stock prices rising consistently, higher highs and higher lows. Positive sentiment dominates. People are excited and optimistic. Good news is everywhere. New investors flood in. Everyone wants a piece of the action because money seems easy. Volume often increases as prices rise, which shows real conviction behind the movement. In a bull market, the atmosphere is electric, hopeful, energetic. Even mediocre stocks tend to rise with the tide. I remember certain bull periods in the U.S. market, like the strong run-ups in tech stocks, when all I had to do was buy solid companies and wait. The gains came naturally. It felt great, almost too great. And that feeling can make us careless. Bear market. Now imagine a bear swiping its claws downward. That's a falling market filled with fear and decline. Signs include prices fall consistently, lower highs and lower lows. Pessimism and anxiety dominate. Bad news spreads fast. Investors retreat. Many leave the market or sit on the sidelines. Volume spikes during sell-offs, a clear sign of panic and mass liquidation. Bear markets feel heavy, frustrating, frightening. Even the strongest companies get dragged down. I've seen friends who were ecstatic in a bull market completely break down when things flipped and turned bearish. They held onto bargains without realizing those bargains could get much cheaper. And cheaper again. 3. Why volume matters. Confirming the trend. To confirm you're reading the market correctly, volume is crucial. Think of volume as the fuel behind every price move. Confirming an uptrend. If prices rise while volume increases sharply, that's a strong bullish signal. It means a large number of investors agree with the move. A low volume bounce is weak and fragile, but a high volume rally that's like a fully powered train moving forward is confirming a downtrend. If prices drop and volume surges, that's a strong bearish signal. It shows widespread fear and heavy selling pressure. A small dip on low volume might be harmless, but a sharp decline on huge volume, that's a real downtrend, and it demands caution. Volume is the market's quiet storyteller. It reveals how many people are truly participating in a move and whether the move has real weight behind it. 4. The danger of catching a falling knife. This is one of the deadliest mistakes investors make. Even experienced ones still fall for it sometimes. Catching a falling knife refers to buying a stock that's falling fast, assuming it's cheap enough or can't drop any further. Imagine a real knife falling from above. Would you try to catch it mid-air? Of course not, you'd get cut badly. The same logic applies to the market. A stock that's dropping hard can always drop more. Cheap today can become even cheaper tomorrow. The bottom you imagine could actually be the top of another leg down. I've made this mistake myself more than once. I remember a tech stock I loved. After a huge run-up, it began tumbling. I thought, great, a discount. It'll bounce soon. I bought. It fell. Bought again. It fell even more. Eventually, I had to cut my losses at a price far below what I thought was the bottom. That painful lesson taught me this: never fight a strong downtrend. Instead, be patient. Let the knife hit the ground. Let it settle. In market terms, wait for real signs of reversal, sideways stabilization, early bullish candles with strong volume, or clear reversal patterns. This takes discipline and emotional restraint. The market isn't always clear. There will be sideways phases, pullbacks, fake-outs. But the core principle never changes. Identify the major trend and move with it. Never underestimate the power of the tide. Understanding and respecting market trends not only protects your capital, it opens the door to sustainable profits. Successful speculation isn't about being smarter than everyone else. It's about having the discipline to follow the market's flow. In the next chapter, we'll look deeper into how to analyze individual stocks and what signs reveal whether a stock truly has long-term potential. Thanks for listening, and I'll see you in the next chapter. In the previous chapters, we've explored market psychology, how to recognize cycles, and the importance of staying disciplined. We've seen that the market is far from a smooth, straight road. But when the market enters a new uptrend, a bull market, that's when the real golden opportunities start to appear. And the key question isn't whether opportunities exist, but this: how do you pick the right stocks to ride that wave? This is Chapter 3, titled The Art of Picking Racehorses: How to Find Leading Stocks. Our goal today is very clear. Learn how to identify and focus your capital on the strongest stocks in a rising market, instead of spreading yourself thin across weak, low-quality names. You know, I'd bet a lot of us made the same rookie mistake when we first came into the market. We loved cheap stocks. Oh wow, this one's so low. Just a couple bucks a share. If it doubles or triples, I'll make a killing. Sound familiar? We tend to hunt for bargain stocks that are dragging along at the bottom, hoping they'll bounce back someday. But successful stock speculation and the real-world experience of many great investors say almost the exact opposite. You should be buying stocks breaking out to new highs, not the ones that just look cheap. It sounds counterintuitive, doesn't it? Buy near the top. Isn't that exactly what everyone tells you not to do? I get that reaction, but think about the logic behind it for a second. A stock sitting at low levels, stuck near the bottom of its range, is usually there for a reason. The business may be struggling. Profits are declining, the industry is in a downtrend, or there's simply nothing compelling enough to attract serious money. It's like seeing an old beat-up car sitting in a junkyard and thinking, hey, this is super cheap. If I fix it up, it might run great again. Sure, maybe in a few rare cases, you can restore it. But most of the time, you'll pour in a ton of time, money, and effort, and it still won't perform like a brand new car cruising effortlessly down the highway. Now flip that around. A stock that keeps breaking out to new all-time highs, meaning the price is stronger than it's ever been, is screaming that it has serious internal strength. Big money is flowing in. Institutional investors are accumulating. The company behind the stock is probably firing on all cylinders. That kind of stock is a true racehorse, strong, resilient, and leading the pack. We want to be riding the racehorse that's already at full gallop, not the exhausted mule struggling to climb out of a ditch. Right? This isn't about buying expensive. It's about buying strength. Buying a stock with powerful growth, even at a higher price than in the past, is often far safer and more profitable than trying to bottom fish a weak, broken name. So how do we actually identify these racehorses? The book, combined with real-world market experience, distills it into 3 key criteria that I like to call the power trio. For spotting a true leading stock, criterion number 1, explosive revenue and earnings growth. This is the backbone of every great company. A stock that can sustain long-term price appreciation must be backed by real business growth. Revenue growth. Look for companies whose revenue is growing steadily and strongly, ideally accelerating in recent quarters. Revenue tells us the company is selling more products or services, gaining market share, or successfully launching new offerings. Year-over-year or quarter-over-quarter revenue growth of 20 to 30% or more is an excellent sign. That often means the company is in a high-growth phase. Earnings growth. Earnings per share. EPS revenue can grow, but if profits don't, or worse, they shrink, that's a red flag. EPS is one of the most important indicators of financial health and profitability. We want to see strong EPS growth, ideally 25% or more per quarter or per year. Sometimes true superstocks show EPS growth of 50%, 100%, or even more over several consecutive quarters. These numbers speak louder than any story they tell you the business is booming, and smart money will naturally gravitate to that kind of company. Remember, a company that grows but can't make money is just a machine burning cash. We want a machine that both grows and prints profits. Criterion number 2. Relative price strength, RS rating. This is a crucial factor that many retail investors overlook. Relative strength tells you how a stock is performing compared to the rest of the market. Imagine this: when the overall market is rising, all boats get lifted to some extent. But you don't want just any boat. You want the fastest one, the one slicing through the waves, not just barely staying afloat. A stock with high relative strength is one that's climbing faster than most other stocks or holding up better during market pullbacks. Professionals often use metrics like a relative strength rating, RS rating, on a scale of 1 to 100. An RS rating of 80 or higher means that stock has outperformed at least 80% of all other stocks in the market over a given period. This makes perfect sense. Big, smart money goes where performance is best. If a stock consistently shows superior strength, that's a clear signal it's being favored by institutions and that it has a powerful story and strong growth potential behind it. You want to ride the strongest horse in the race, not the one lagging behind the herd. To make this more concrete, think back to some of the superstar stocks of past decades. For example, companies like Amazon or Netflix during their hyper-growth phases, or Apple as the iPhone took over the world. If you looked at their financials back then, what would you have seen? Exploding revenue, relentlessly rising earnings, price charts punching out new highs again and again. Even when the overall market corrected, these leaders might dip, but they usually bounced back faster and stronger than the average stock. These were the companies reshaping their industries, launching disruptive products, or running incredibly efficient business models. The problem is, by the time most people finally notice these stars, the stock price has already run up a lot. But don't let that scare you away. If a stock checks all the boxes, strong revenue growth, powerful earnings growth, and elite relative strength, then it making new highs may actually be just the beginning of a much longer journey. Again, remember, it's better to buy right than to just buy cheap. The final piece. Understand the industry behind the stock. A fast racehorse usually comes from a strong racing field. In other words, a true leading stock is often part of an industry that itself is in a powerful uptrend, benefiting from big macro trends, new technology, or shifts in consumer behavior. Ask yourself, is this industry riding a major long-term tailwind? For example, digital transformation, renewable energy, AI, e-commerce, new consumer trends. What forces are driving this industry's growth? Government policies, technological breakthroughs, surging demand, demographic shifts, etc. Is this industry in its golden phase of expansion? A great company stuck in a dying industry will find it very hard to become a super stock. On the other hand, a strong company in a booming industry gets that extra wind in its sails to go much farther, much faster. So always start with the industry trend first. Then drill down to find the standout companies within that rising sector. That way, you're not just finding the right racehorse. You're also picking the right racetrack for it to dominate. So we've just walked through the art of choosing racehorses in the stock market. Let's recap the 3 core ideas. 1. Don't be afraid to buy stocks at new highs if they have solid fundamentals. Strength begets strength. 2. Look for the power trio. Explosive revenue growth, surging earnings growth, high relative price strength compared to the overall market. And 3. Never skip the step of studying the industry the stock operates in. A great racehorse still needs the right track to really shine. Finding true leading stocks takes patience, deep research, and a mindset that's different from the crowd. But with these principles, you now have a much stronger compass to guide your investing journey. In the next chapter, we'll dive deeper into risk management and talk about when to get off the horse. In other words, when and how to take profits and lock in your gains. If you found this video helpful, go ahead and hit like, share it with a friend, and subscribe so you don't miss the upcoming chapters. Drop a comment below and tell me how you look for your own racehorse stocks. I'd love to hear your stories. Thanks for watching, and I'll see you in the next chapter. Wishing you all the best on your investing journey. Hello everyone, this is WealthRise Stories, and I'm sure that if you've ever browsed through investing forums or flipped through any stock market book, you've probably seen one sentence repeated over and over again. You can buy the right stock, but if you buy it at the wrong time, you can still lose money. Sounds harsh, right? But that's the cold, unfiltered truth of the market. Picture this, you're about to run a marathon. You've trained hard, you know the route, and you've got the best running shoes you can afford. Everything is perfect. But if you start too early before the gun goes off, or too late when everyone else is already halfway down the course, then no matter how strong or prepared you are, you're not finishing with a great result. In the stock market, timing is that starting gun. 1. The breakout. When the spring has been fully compressed. In successful stock speculation, and really in most growth investing and trend trading philosophies, the concept of a breakout is the golden key you need to master. Think of a stock as an athlete. After a strong run-up, they need time to rest, catch their breath, and digest the gains. During this time, the stock usually moves sideways, trades in a tighter range, or dips slightly. This is what we call a consolidation base. This is the period where big money players, institutions, funds, professional traders quietly accumulate shares. They buy from smaller retail investors who are bored, impatient, or taking short-term profits. To the untrained eye, this phase looks boring and uneventful. But to those who understand what's happening, this is when the spring is being compressed tightly, quietly preparing for an explosive move. And the moment the stock breaks out of that sideways zone, when price pushes above a key resistance level, with strong momentum, that is the breakout we're looking for. It's a clear signal that the stock is ready for a new leg up, usually triggered by fresh positive news, or simply by large institutional demand stepping in. 2. Using classic chart patterns to spot potential buy points. So how do we identify these consolidation bases effectively? We use chart patterns, footprints of investor behavior left on price charts, proven reliable over decades of market history. Cup and handle pattern, one of the most iconic and reliable patterns popularized by William J. O'Neill, the father of growth investing. Visualize a coffee cup with a small handle on the right. The cup is the stage where the stock corrects and then recovers, forming a rounded U shape. Then comes the handle, a smaller pullback or sideways drift at the upper part of the cup. This phase shakes out the last weak holders. The buy point is when price breaks above the top of the handle, the highest point before the breakout. Flat base, A simpler but extremely powerful pattern. After a solid run-up, the stock moves sideways in a tight range, usually no more than 10–15% depth, for at least 4 or 5 weeks. The buy point is when price breaks above the top of that flat range. This pattern shows exceptional strength. The stock is pausing and consolidating, not collapsing, getting ready to climb again. Of course, the market isn't always textbook perfect. But understanding these patterns gives us a reliable map to find safe, high-probability entry points. 3. The importance of buying on breakouts with strong volume. This is something I want you to tattoo into your brain. Volume matters a lot. Imagine watching a championship game, and someone scores the winning goal. If the stadium is dead silent, would you feel convinced that it was a real game-changing moment? Same with stocks. When price breaks out, you need to hear the crowd roar, and that roar is a surge in volume. Price up, beer. Big volume, dear, strong signal. A breakout with volume 40–100% above the 50 or 200-day average usually means institutional money is flooding in. That's real demand, the kind that sustains big moves. Price up plus weak volume. Be careful. A breakout with low volume is often a fake-out, an unsustainable move without real conviction behind it. Volume is what confirms whether a breakout is genuine or just noise. Learning to read price by volume together is one of the most powerful skills you can develop. 4. The common and costly mistake, chasing a stock after it's gone too far. Now we get to one of the most painful sins in trading, especially for beginners. Chasing the price. You've been watching a stock. It breaks out. You miss the perfect buy point. Then it shoots up 10%, 20%, 30% within days or weeks, and panic kicks in. Oh no, I missed a monster winner. Okay, fine, I'll just buy now. It'll probably keep going. That's precisely when risks skyrocket. Your stop loss becomes too wide. Buying far above the base means that even a normal pullback can slam you with a big loss. Risk-reward becomes terrible. One of the golden rules in investing is to aim for high reward with low risk, not high risk with uncertain reward. I've made this mistake myself many times when I first started. Watch stock go up, panic, buy high, immediate correction, frustration. Why am I so unlucky? It wasn't bad luck. It was bad timing. Big lesson. It's better to miss a trade than to force a bad one. Be patient. The market always offers new opportunities. There will always be another stock building a fresh base. The pros wait for the next setup, they don't chase the old one. So let's recap the core lessons of the golden timing. 1. Look for breakouts from a consolidation base. That's when a stock is ready for its next run. 2. Use chart patterns like cup and handle and flat base to spot clean, safe entry points. 3. Always check volume. Strong breakouts require strong participation. 4. Avoid chasing after a stock that has already run too far. Patience, FOMO. These aren't just theories, they're principles proven over decades by some of the most successful traders and investors in the world. Study them. Apply them. Observe how they play out on your charts, and you'll start seeing the difference they make. I hope Chapter 4 has given you the clarity and confidence you need to time your entries better. If you found value in this video, don't forget to like, share, and subscribe so you don't miss the upcoming chapters. In Chapter 5, we'll dive into an equally important and arguably life-saving topic, and risk management. When should you hit the sell button? Trust me, there are some expensive lessons waiting there. Thanks for listening, and thank you for being part of this journey. Here's to smarter, sharper, more disciplined decisions on your investing path. If in the previous chapters we've talked about finding opportunities and analyzing the market, then today we're going to dive into a dimension that I dare say is absolutely critical, the foundation for anyone who wants to survive and grow sustainably in the financial markets: risk management. Chapter 5. Risk Management. Survival Rule number 1. Don't lose money. Yes, you heard that right. Don't lose money. It sounds obvious, but it's the rule that gets broken the most, and it's the number one reason why so many speculators, even after some spectacular early wins, end up with nothing. In the world of speculation, the goal is not get rich quick. It's protect your capital so you can stay in the game. Think of it this way. You're a soldier on the battlefield. The first thing you need to learn is not how to charge straight into the front line and take down the enemy, but how to protect yourself, how to stay alive so you can fight again tomorrow. Your capital is your lifeline in this market. The book drives home a core idea. A great speculator is not someone who never loses money, but someone who knows how to keep losses as small as possible. Losses are unavoidable. You will make mistakes. You will have bad calls. But how you respond to those mistakes is what ultimately determines your success. We're going to walk through 4 golden rules that help you build a solid layer of armor around your capital. 1. The most important rule. Always use a stop loss. If there is only one thing you take away from this chapter, let it be this. A stop loss order is your best friend, your life jacket, your strongest shield. So what is a stop loss? Simply put, it's an order you set with your broker in advance to automatically sell a stock if its price falls to a level you've predetermined. Why is it so critical? It removes emotion. When the market moves against you, human nature wants to hope, justify, and say, maybe it'll bounce back. A stop loss wipes that dangerous emotion out of the equation. It's a rational decision made before your emotions get involved. It limits damage. It's like a safety net. You know exactly how much you're willing to lose on a single trade. This keeps sudden price collapses from blowing up your account. It frees your mind. Once your stop is set, you don't have to stare at the screen all day. You know that no matter what the market does, your downside is controlled. I know taking a loss hurts. No one likes admitting they were wrong. But think of it as a cost of doing business. Small, controlled losses are the price you pay for the chance to earn larger gains later. If you don't cut off the infected finger, you risk losing the entire arm. 2. How to set a reasonable stop-loss example. 7-8% below your entry. Using a stop-loss doesn't mean placing it randomly. It needs to be strategic. The book, along with many successful traders, often suggests a starting point about 7-8% below your initial purchase price. Let's break that down. Why not 1-2%? If your stop is too tight, you'll get shaken out constantly by normal day-to-day price noise. Stocks almost never move in a straight line, they wiggle. You'll get stopped out over and over and rack up transaction costs. Why not 15-20% or more? On the flip side, if you place your stop too far away, say 15-20%, your losses get way too large and become hard to recover from. To make back a 20% loss, you need a 25% gain. To make back a 50% loss, you need a 100% gain. Once the drawdown is too deep, the math starts working against you. Around 7-8% is considered a sweet spot. It gives the stock enough room to breathe through normal volatility, but still keeps the loss manageable if the stock is truly moving in the wrong direction. Of course, this is just a general guideline. You should adjust your stop based on volatility of the stock. More volatile stocks may require slightly wider stops or smaller position sizes to keep risk per trade constant. Technical structure. You can place stops below key support levels, recent lows, or important moving averages you follow. Your personal strategy and risk tolerance. The most important principle is this. Decide your stop-loss level before you enter the trade and never move it lower once price gets close. Moving your stop further down is just stretching out the pain for a bigger loss. Discipline is everything. 3. The rule, never let a profit turn into a loss. This is a psychological trap that a lot of traders in the US fall into. You buy a stock, it goes up. You're up 5%, 10%, 15%. You feel great. You tell yourself this trade is solid and you keep holding. Then for whatever reason the market reverses. The stock pulls back, your profit shrinks, then goes to break even, then dips into red. At that point, you start hoping it'll bounce, and the emotional spiral begins. Don't let that happen. Once you're sitting on a profit, even a small one, you need a plan to protect it. Raise your stop trailing stop. When the stock moves higher, you can move your stop up with it. For example, you buy at $100 and set your initial stop at $92, then 8% risk. The stock moves up to 110. At that point, you can raise your stop to your entry $100 or even to $105. That way, even if the market reverses, you've locked in at least some profit, or at worst, you break even. Take partial profits. If a stock runs hard and you've got a solid gain, consider taking some money off the table. For example, sell 1/3 or half your position to put real cash in your pocket. Let the rest ride with a trailing stop. This not only protects your capital, it frees up cash for new opportunities. Stick to your plan. Greed makes us want to hold forever, trying to squeeze out every last dollar. But the market rarely cooperates with that fantasy. Set profit targets. When the stock reaches your target or shows clear signs of reversing, don't hesitate. Remember, the ultimate goal of any trade is to make money. Letting a winning trade turn into a loser is one of the most painful mistakes you can make in the market. 4. Position sizing. Never bet too big on a single trade. This is a risk management rule that goes hand in hand with using stop losses, even if you have a clear stop level. If you put too much money into one trade, just a few losing trades can do serious damage to your account. Imagine you have $10,000. You decide to put $5,000 into a stock and set an 8% stop loss. That means you're risking $400 on that trade. If you lose 3 trades like that in a row, you're down $200 or 12% of your entire account. That's a big hit, and it will shake your confidence and your ability to recover. Position sizing rules say, you should never risk more than a certain small percentage of your total capital on any single trade. This percentage is often 1% to 2%. Example, you have $10,000. You decide you're only willing to risk 1% per trade, that's $100. You buy a stock at $100. Then your stop loss is at $92, an $8 risk per share. The number of shares you can safely buy is $100 max risk per trade, 8 risk per share, 12.5 shares. In the real world, you'd round down to 12 shares. Your total position size is $100 or $200. Even though you have $10,000, you're only putting $200 into this trade because of the 8% stop and your 1% risk rule. The general formula is position size, total capital, max risk per trade, entry price, stop loss price. It might sound a bit technical, but the core idea is simple. Don't let one bad trade destroy your account. By capping your risk on each trade, you build a safety buffer. You could lose 5, then 10, even 20 trades in a row, which is unlikely if you have a solid strategy, and you'd still have enough capital to stay in the game and catch the next good opportunity. Position sizing helps you spread out risk, not dump all your eggs into one basket. It helps you stay calm and rational because you know that even if this trade fails, it's not the end of the world. Chapter 5 may not feel as exciting as hunting for the next big growth stock, but it is the most important chapter if you want to turn trading from a gamble into a disciplined, structured endeavor. Let's recap. 1. Always use a stop loss, your first wall of defense for your capital. 2. Set a reasonable stop loss level, typically around 7 to 8%, adjusted for volatility and context. 3. Never let a profit turn into a loss. Protect your gains with trailing stops or partial profit taking. 4. Manage position size. Keep risk per trade around 1–2% of your total capital. Remember, the market will always be there. Opportunities will always exist. Your job is to make sure your capital is still there to seize them. Discipline in risk management doesn't just protect your account, it builds the rock-solid mindset that every successful trader and speculator needs. In the next chapter, we'll dive into more specific strategies for finding and identifying high-potential stocks. And we'll layer those strategies on top of the risk management principles we've just learned. Don't miss it. If you found this video helpful, don't forget to like, share, and subscribe so you don't miss future content. Awesome. Welcome back to the channel. I'm WealthRise Stories, and today we're diving into a topic most people don't really enjoy talking about, but it's absolutely crucial, arguably even harder than picking which stock to buy, the art of taking profits and leaving the table. Welcome back to our video series breaking down the classic book, Successful Stock Speculation. In the previous chapters, we've explored the wide world of finding, analyzing, and deciding when to buy a promising stock. The journey of being a hunter of opportunities. Today we're turning to a completely different page. This one is about a skill that's often overlooked, an art that can be even more subtle and complex than buying, the art of selling. Let's be honest, all of us love that feeling of buying a stock and watching it shoot up. That sense of victory, that rush of seeing your money grow, it's addictive. But here's a tough truth that even very experienced investors eventually have to face. Knowing when to sell is sometimes even more important than knowing when to buy, because profits on paper are not real profits until you actually lock them in. It's like going to an amazing party, endless food, great music, everyone's hyped. But if you don't know when to stand up and leave, you might end up being the last one there when everything's over, or worse, you miss your ride home and are left alone with nothing but regret. Our book devotes an entire chapter to this topic. And I truly believe this is one of the most expensive lessons every investor needs to carve into their memory. Let's break it down. 1. Signs a stock is topping out and about to reverse. The warning bells at the party. So how do you know when the party is winding down, or at least when it's not as fun as it used to be? There are subtle signals that, if you pay attention, act like alarm bells. Extreme euphoria and too good to be true news. I remember a time when a stock I was holding was going vertical. Suddenly, it was everywhere. Articles, interviews, glowing features. Friends who had never talked about the stock market in their lives started asking me about that ticker. Financial news channels were running non-stop positive coverage. Phrases like unlimited potential and game-changing technology were all over the place. That's usually when I start getting nervous. When everyone is wildly optimistic, when belief becomes almost blind, that's often a sign we're near a peak. Trading volume explodes, but price stops advancing or starts stalling, rolling over. On the chart, you'll see sessions with huge volume way above the average. At first, price may still push higher, but then you notice it starting to flatten out, or even slip a bit, while volume stays heavy. That's often a sign of a tug of war between buyers and sellers. Buyers are still trying to push it higher, but big sellers have started unloading. This is called distribution, or sometimes churning at the top. Volatility spikes. A stock near a top often has wild swings, large up days, followed by sharp down days. Big intraday ranges signal instability and lack of clear direction. Large players may be pushing and pulling the price as they try to exit. Bearish reversal patterns on the chart. Technically, you might see topping patterns like head and shoulders, bearish engulfing candles, shooting stars, or long upper wicks near the highs. These are visual clues that buying pressure is fading and selling pressure is growing. Divergence between price and indicators. RSI, MACD, etc. This is a more advanced signal. When price keeps making new highs, but momentum indicators like RSI or MACD start making lower highs, bearish divergence. It suggests the underlying strength behind the move is weakening and a reversal becomes more likely. Price can't hold key support levels anymore. After an uptrend, a strong stock usually respects important support zones. If it breaks below those supports on big volume, that's a serious warning sign. These signals won't always show up all at once, but if you start seeing several of them together, it's time to pay attention. That might be your cue to think about leaving the table. 2. The technique of selling on the way up. Taking profits in stages as the stock hits targets. A lot of people treat selling as an all-or-nothing decision. Either they hold everything or they dump everything. That usually leads to one of two outcomes. 1. They sell too early and miss the next big leg up. 2. Or they hold too long and give back all their gains to the market. To avoid those emotional traps, the book encourages us to use a strategy called selling on the way up or taking profits in stages. It's a very effective way to manage risk and protect your gains. Set clear profit targets. From the moment you buy a stock, you should have a concrete profit goal in mind. For example, maybe you're aiming for 20%, 50%, or even 100% if it's a strong growth stock. Sell in tranches, not all at once. Instead of selling everything at your first target, sell a portion. For instance, when the stock is up 20%, you sell 25% of your position. When it's up 50%, you sell another 25%. Step by step, you're pulling profits out and putting them in your pocket without bailing out entirely too early. Psychological relief. Taking profits gradually reduces a lot of emotional pressure. You've already locked in real gains, which makes it easier to stay calm if the stock pulls back. You still have skin in the game if the price keeps climbing, but you've also protected part of your winnings. It's like enjoying a great meal. You savor it slowly, bite by bite, instead of stuffing everything in at once and regretting not tasting it properly. A practical example. Let's say you buy 1,000 shares of XYZ at $10. When the price hits $12, up 20%, you sell 250 shares. You've just booked $500 in profit. When the price hits $15, up 50% from your entry, you sell another 250 shares. You lock in another $1,250 gain. Now you still hold 500 shares, but you've already secured $1,750 in profits. You can continue to hold the remaining shares for further upside, and you can protect them with a trailing stop at break-even or above. At this point, even if the stock somehow goes to zero, you've already recouped your capital and made a profit. This strategy helps you avoid the inner tug-of-war between greed and fear and lets you ride the uptrend more calmly. 3. The difference between selling because the stock is weak versus selling because the whole market is turning. This distinction is extremely important and often misunderstood. You need to know exactly why you're selling. Is it because your stock is breaking down or because the overall market tide is going out? Selling because the stock itself is deteriorating. Possible reasons. Fundamental deterioration. The company reports disappointing earnings, margins shrink growth, slows leadership changes for the worse. Key products flop, competitive pressure surges, or the specific industry is in trouble. The uptrend clearly breaks. The stock had been making higher highs and higher lows, but then it starts making lower highs and lower lows, especially with heavy volume. Stock-specific bad news. Scandals, lawsuits, regulatory issues, major missteps by management, etc. Response. In these cases, your decision to sell should focus on the stock itself. Reevaluate your original thesis. If the reasons you bought it are no longer valid, or the risk has jumped significantly, selling to protect capital makes sense, regardless of whether the broad market is still okay. Your goal here is to remove the sick horse from the stable. Selling because the overall market is turning, the tide is going out. Possible reasons. Sometimes your stock is still fundamentally fine. Nothing is obviously wrong with the company, but the entire market is entering a correction or a full-blown bear phase. Macro factors like rising interest rates, higher borrowing costs hurt corporate profits and push investors towards safer assets. High inflation. It erodes purchasing power, squeezes margins, and slows demand. Economic slowdown or recession, corporate earnings across the board start declining. Global political or economic instability. Wars, pandemics, energy crises, and other shocks can create massive selling pressure worldwide. Response. When the tide goes out, even the best boats struggle. In this situation, you might choose to reduce your overall stock exposure or raise more cash across your portfolio. You're not necessarily selling because your stock is bad, but because the environment has turned hostile. A great stock can still drop hard in a bad market. Selling in this case is about protecting your total wealth from systemic risk. Once the storm passes, you can use that cash to buy quality stocks at much better prices. Understanding the difference between these two scenarios helps you make clearer, less emotional selling decisions. 4. The psychological trap of holding too long because you hope it will go up forever. Now we get to the hardest part, the part almost all of us have experienced at least once. The trap of greed and FOMO, fear of missing out. When a stock just keeps going up, especially when it's already given you a big gain, a little voice in your head starts whispering, "It's going higher. Why sell now? What if it doubles from here? You'll regret selling too early." That voice is pure greed, a blind hope that this stock is going to change your life and rise forever. Painful regret mode. I remember a time when I held a stock that had gone up more than 300%. I was proud. Everyone congratulated me. I didn't sell. I told myself it's going higher. All the experts say so. Then the market corrected. The stock dropped 50% from its peak. I still didn't sell because I was anchored to that 300% gain on paper. I kept thinking, it'll come back. Just wait. In the end, I gave back almost all of my profits and only walked away with a tiny gain. That was a brutal lesson. Profits on paper are not real until you take them. Fear of regret. We humans hate the feeling of regret. Selling and then watching the stock keep climbing is painful. So we'd often rather hold on and risk losing current profits than face the emotional discomfort of saying I sold too early. Falling in love with your stock. Sometimes we develop an emotional attachment to our stocks. We believe deeply in the story, the CEO, the mission. That can blind us. We ignore warning signs, downplay bad news, and twist any information to justify holding on. The book emphasizes that having a clear exit plan before you buy and sticking to it with discipline is the key to overcoming these traps. Set clear stop-loss and take profit levels from the start. Know when you'll sell if things go wrong and when you'll sell if things go right. Don't let your emotions run the show. Once you've made a plan, follow it regardless of how you feel in the moment. The market doesn't care about your feelings, except that you will almost never sell at the exact top. That's just reality. Don't chase perfection. Be content with reasonable, solid profits, and let someone else worry about squeezing out the last few percent. Always convert some of your gains into real cash. Money sitting safely in your account is yours. It gives you flexibility for future opportunities and lets you sleep better at night. So we've just walked through the most important aspects of the art of selling stock, a skill that's often ignored but absolutely foundational for long-term success. From recognizing the warning signs that the party is ending to using partial profit-taking to protect your gains, and finally to overcoming the psychological traps of greed and FOMO. Remember this: the stock market is not a place to prove your loyalty to a ticker symbol. It's a place to protect and grow your capital. Knowing when to leave the table, when to say goodbye to a stock, that's the mark of a smart, disciplined investor. Sometimes, the best decision you can make is to know when to stop, take your profits, and live to fight another day. Thank you for watching. I'll see you in the next chapter of Successful Stock Speculation. Welcome back to the channel, and welcome back to our little corner of YouTube, where we dive deep into timeless wisdom from classic books on investing and trading. Today we're continuing our journey with successful stock speculation, and we're going to zoom in on a chapter that I personally believe is one of the most important foundations for building a sustainable trading career. That is Chapter 7, Keeping a Trading Journal, Your Roadmap to Success. When it comes to trading stocks or any other form of investing, most people obsess over strategies, indicators, and quick tricks to make money. But there's one thing very few people truly take seriously, and even fewer do consistently, writing down every single trade. It sounds simple. Honestly, it even sounds a little boring, right? But I promise you, this is not just some administrative busywork. It is a powerful tool, a real-life map that leads you toward deeper understanding of yourself and the market. Our goal in this chapter is to encourage you to turn journaling into a non-negotiable habit, a way to transform experience, whether it's a win or a loss, into solid, durable wisdom. Why is writing down your reasons and emotions so important? Think about it. In everyday life, we often repeat the same mistakes over and over, simply because we never stop to really examine why they happened. In trading, that problem is multiplied by 10. The market is a highly volatile environment, and emotion is the #1 enemy of every trader. Writing down your reasons for buying, selling. Do you actually remember why you bought stock A on that particular day? Was it because you carefully analyzed the chart, checked the financials, and saw a clear setup? Or was it because you heard a hot tip from someone? When you clearly record why you entered a trade, for example, bought XYZ because price broke above resistance on strong volume, MACD crossed up expecting a strong quarterly earnings report. You're leaving a footprint of your decision. Later, when you look back, you can see whether your original thesis was solid or whether you got distracted by something else. This is how you audit your own discipline and consistency. A lot of traders actually have decent strategies, they just don't follow them. The journal exposes that truth. Writing down your emotions during the trade. This is the psychological part of journaling, and honestly, I think it's even more important than logging the technical reason. Did you feel overly excited when the price went up? Were you so scared during a small pullback that you panic sold at the worst possible moment? Greed, fear, impatience, overconfidence. These emotional demons are the real drivers behind most bad decisions. Picture this, you're watching a stock grind higher day after day. You feel FOMO, fear of missing out, and you jump in. Right after you buy, the stock starts to drop. Now you feel disappointed, angry, anxious about losing more money, so you dump it at the bottom. If you write that down in your journal, felt heavy FOMO when I bought, and then panicked when price dipped slightly and sold at the low, and later review it, you'll start to see a pattern. Oh, I tend to buy when I'm in FOMO and sell when I'm in panic. Recognizing those emotional patterns is the first and most important step toward controlling them. It turns your personal mistakes into objective data you can study instead of just fuzzy, painful memories you'd rather forget. What should a good trading journal include? A powerful trading journal doesn't have to be complicated, but it does need to capture all the key information you'll want to analyze later. I recommend including at least the following for every trade. 1-point date at a time. The exact time you entered or exited the trade. 2-point ticker symbol. The specific stock or asset you traded, for example. AAPL, MSFT, TSLA. 3-point action. Did you buy or sell? 4. Position size. How many shares or contracts did you buy, sell? 5. Entry, exit price. The actual execution price. 6. Stop loss level. The price you set from the beginning where you'll cut the loss to protect your capital. This is critical for evaluating your discipline. 7. Target price, take profit. The level where you plan to take profits if applicable. 8. Reason for the trade. This is where you write down your analysis. Was the trade based on technicals, chart patterns, indicators, fundamentals, earnings, news, industry outlook, or something else? 9. Emotional state at the time note. Your mindset when you took the trade, confident, anxious, excited, fearful, greedy, rushed, etc. 10. Result. The final profit or loss in dollars and in percentage terms, for example, plunged 5%, 3%. 11. Lessons learned. This is the diamond of the entire journal. After the trade is closed, win or lose, ask yourself, what did I do well? What mistake did I make? What will I do differently next time? For example, Lesson: don't buy when a stock is already extended far above support, wait for a pullback. Or lesson: held too long because of greed. Should have stuck to original profit target. 12. Additional notes, optional things like overall market conditions, relevant news, the position size relative to your total account, or any other factor that influenced your decision. You can use a physical notebook, an Excel, Google Sheet, or dedicated trading journal app. The specific tool doesn't matter as much as consistency. Journaling is step 1. Reviewing it is where the magic happens. Writing things down is just the beginning. The real value of a trading journal comes from reviewing and analyzing it regularly. This is where you turn raw data into useful information and information into true insight. I recommend setting aside time, at least once a week or once a month, to review your journal. Treat it like a performance review meeting with yourself. Look for patterns. Repeated mistakes. Do you consistently move your stop loss lower, hoping for a bounce? Do you frequently cut profits too early? Do you jump into trades based on rumors without real analysis? Are there certain types of stocks or setups you keep losing money on? Spotting these recurring mistakes is the first step to eliminating them. Winning strategies. On the flip side, look at your successful trades. What made them work? Which setups, timeframes, or conditions tend to produce your best results? Which indicators actually help you, and which ones just clutter your screen? Capture what you did right, so you can intentionally repeat it. Impact of emotions. Look at the emotions column. Do you see a pattern where you make poor decisions when you're nervous or overconfident? When do your emotions help you stay disciplined? And when do they push you into reckless behavior? Evaluate your discipline. Did you stick to your stop loss? Did you ever move your stop farther away just to avoid being stopped out? Did you follow your profit-taking rules? Did FOMO or FUD, fear, uncertainty, doubt, push you into trades you shouldn't have taken? Adjust your strategy. Based on your review, you can refine your strategy. If a particular approach keeps failing, dig in and figure out why. Maybe it doesn't fit your personality or risk tolerance. If another strategy consistently works well, think about how you can focus more on it and optimize it further. Think of your trading journal as a very special kind of teacher, one that's tough, but totally fair. Tough because it never lies to you. It will highlight all your mistakes, weaknesses, and lapses in discipline in cold, hard detail. When you see a string of losing trades, the journal won't blame the market or your broker or the news. It will show you exactly how your own decisions led to those outcomes. That's not easy to face, but it's the truth you need in order to grow. Fair. At the same time, your journal is completely fair. It records your successes just as objectively. It doesn't exaggerate or downplay anything. When you have a streak of winning trades, the journal will reveal what you did right. The setups, rules, and behaviors that led to those wins. That helps you build confidence in your strategy and in yourself. It's the clearest mirror you'll ever have for your trading behavior and performance, unclouded by emotion or ego. Through this teacher, you'll learn your most valuable lessons about the market, and even more importantly, about yourself. It will help you build discipline, cultivate patience, and understand both market psychology and your own psychology on a deeper level. My friends, the road to becoming a successful trader is anything but smooth. It's full of challenges, doubt, and costly lessons. But with a carefully maintained and regularly reviewed trading journal, you no longer have to walk that road in the dark. You'll be holding a detailed map drawn from your own experience, showing you where the traps are and where the paths to success really lie. Don't think of journaling as a burden. Think of it as an investment in your own education, an investment that never loses money. Keeping a trading journal is the best way to turn each trade, win or lose, into a lesson, and each lesson into one more step toward mastery. Start today. Start documenting your journey in the markets, and I truly believe you'll be surprised by how quickly you improve. Thank you for listening. I hope this inspires you to start or restart the habit of keeping a trading journal. See you in the next part where we'll uncover more insights from successful stock speculation. Don't forget to like, share, and subscribe so you don't miss any future content. Wishing you smart, disciplined, and successful trading. And now we've reached the point where we can't just know anymore. We have to act. It's time to pull together all that valuable knowledge and turn it into something practical. A real tool, a system that actually runs smoothly and efficiently. Welcome to Chapter 8, Building Your Own Trading System. Think of this as assembling your own race car. You've learned about the engine, the chassis, the tires, how to optimize performance. Now it's time to put it all together, tuning it to match your driving style, the road you're on, and the speed you want to achieve. 1. There is no holy grail system for everyone. The first and probably most important thing to understand when we talk about building a system is this: there is no holy grail in stock trading. There is no magic formula, no miracle indicator, no buy-sell system that works for everyone in every market condition. Why? Because the market is always changing. It's a living, breathing organism that constantly shifts and evolves. And even more importantly, we are all different. We each have a unique personality, a different level of risk, tolerance, different amounts of time we can spend watching the market, and totally different financial goals. A system that works brilliantly for a trader with iron discipline and a high-risk appetite can be a total disaster for someone who's more cautious and emotionally sensitive to drawdowns. Our goal is not to hunt for someone else's perfect system. Our goal is to build a system that fits you, a system you understand deeply, trust completely, and feel comfortable running. It should reflect who you are and align with your personal investing philosophy. 2. The core components of a complete trading system. So what does a complete trading system actually look like? Picture it as a finely tuned machine. Each part has its own job, but when everything works together, it becomes something powerful. We'll break it down into 4 main components. A. Stock selection criteria. This is your first step, your filter. What exactly are you looking for in a stock? Fundamentals. Do you prefer companies with strong revenue growth, high profit margins, trustworthy, competent management, or businesses that are undervalued relative to their true potential? Technical factors. Do you favor stocks in clear uptrends, names that are consolidating and look ready to break out, or blue chip stocks that have pulled back to strong support levels? Industry focus. Do you want to focus on sectors like tech, healthcare, energy, or consumer? Or would you rather stay diversified across multiple sectors? Write these criteria down clearly. They help you cut through the noise and focus only on high-quality candidates. B. Entry rules. When you buy. Once you've found your short list of promising stocks, when is the right moment to actually pull the trigger? Will you buy when price breaks above a key resistance level? When price pulls back to the 20-day or 50-day moving average and bounces? When a specific candlestick pattern appears, for example, a pin bar at support? When a technical indicator like RSI or MACD gives a clear buy signal? Your entry rules should be clear, objective, and specific. The goal is to keep you from buying based on emotion, rumors, or crowd behavior. You're waiting for your signal, the one your system defines. See exit rules when you sell. This is often the hardest part, but it's also the most important piece of any trading system. You need to know exactly when you'll get out, both to cut a loss and to take a profit. Stop loss cutting losses. This is your safety harness. You must define your emergency exit before you ever hit the buy button. Will you cut the loss if the stock drops a certain percentage from your entry? If the price closes below a key support level? If it breaks below a moving average you rely on? Absolutely never forget to place or honor your stop-loss rules. They limit the damage, protect your capital, and keep you alive long enough to fight another day. The market doesn't care about your feelings, and hesitation can quickly turn a manageable loss into something you may never fully recover from. Take profit, locking in gains, set realistic profit targets. Will you take profits once the stock hits a specific return, say 15% or 20%? When price hits a major resistance level, when a technical indicator shows overbought conditions and signs of reversal? Or will you use a trailing stop to ride the trend while still protecting your gains? Don't let greed take over. The market can take back what it gave you fast. It's better to leave a little on the table than to watch a winning trade turn into a loser. D. Money management rules. This is the backbone, the heart of your system. This part determines whether you can survive long enough to see your edge play out. Position sizing. How much of your capital will you commit to each trade? 1% of your account, 2%. It should never be so much that one bad trade can seriously damage your entire portfolio. Fixed risk per trade. Decide how much money you're willing to lose on a single trade. For example, you might risk no more than 1% of your account per position. From there, you calculate how many shares you can buy based on your stop-loss level. Diversification. Will you spread your capital across several stocks or concentrate in just a few that you really believe in? Money management is the art of protecting your resources, making sure you still have capital after a losing streak. Remember, capital preservation is priority number 1. 3. The importance of backtesting and discipline. Designing a system on paper is one thing. Knowing whether it actually works in the real world is another. That's where testing comes in. Backtesting. Apply your system rules to historical market data. Scroll back through charts and see how your entries and exits would have performed over hundreds, even thousands of past trades across different market conditions, uptrends, downtrends, and sideways periods. Ask, what's the win-loss ratio? What's the average profit on winning trades? The average loss on losing trades? What was the largest losing streak? Backtesting won't guarantee future results, but it gives you an objective view of your system's potential. From there, you can tweak and fine-tune your rules. Paper trading, forward testing. After backtesting and feeling reasonably confident, try running your system in real time, but with paper money demo account, simulated trades. This lets you practice executing your rules in a live moving market without putting real cash at risk. You still experience the emotions, the timing pressure, the urge to deviate, but you get to iron out the kinks before going full size with real money. And finally, the big one, discipline. Even the best trading system in the world is worthless if you don't follow it. We're human. We get scared when the market drops. We get greedy when the market rips higher. Do you cut a loss when your system tells you to, even if you feel like it might bounce soon? Do you take profits when your rules say it's time, even if part of you wants to hold for just a little more? Do you sit on your hands and wait for a real signal instead of jumping in because of FOMO? Discipline is the bridge between your goals and your results. Treat your system like a trusted friend. Don't abandon it just because of a few early stumbles. Give it time to prove itself, and most importantly, trust the process that you yourself built. 4. A little encouragement. This is a marathon, not a sprint. My friends, the journey to becoming a successful speculator is a marathon, not a 100-yard dash. It demands patience, a willingness to learn from your mistakes, and a mindset that's always looking to improve. You will stumble. You will have bad trades, bad days, bad weeks. You'll take losses you didn't expect. That's normal. Even legendary traders have losing days. What truly matters is how you respond. Do you go back and review what went wrong? Do you adjust your system based on what you've learned? Or do you quit? Think of world-class marathon runners. They don't sprint all out from the starting line. They have a plan. They pace themselves. They know when to push harder and when to hold back and conserve energy. They feel pain and fatigue, but they don't give up on the finish line. Your trading system is not a finished product on day one. It will grow with you. It will evolve with your experience. Keep evaluating it, testing it, and refining it. Be patient with the system and with yourself. So here we are. We've walked through all the key pieces. Now it's your turn to put them together. Start right now. Write down your rules, even if they feel simple or imperfect at first. Turn those dry principles into sharp tools that are truly your own, because only then are you really in control of your financial journey. In the next chapter, we'll dive deeper into how to stay mentally steady while running your system, how to handle the psychological challenges, and push through them. Thank you for listening, and I'll see you in the next video. Wishing you good luck and great success in your trading journey. Hey everyone, welcome back. We've already come quite a long way together, haven't we? From the most basic principles of speculation, to reading market psychology, to truly understanding the importance of discipline. I know sometimes the sheer amount of information can feel overwhelming. It's like someone just handed you an incredibly detailed treasure map. But you're not really sure where you're supposed to start digging. Don't worry, because that's exactly why we have this section 11, the 7-day action plan from theory to real-world practice. My goal today is to give you a clear, step-by-step roadmap so you can turn all this valuable knowledge into real action. We're not just going to talk theory anymore. We're going to do things bit by bit to build habits and confidence. So think of the next 7 days as a short training camp where you are the trainee and the market is your instructor. Ready? Let's dive in. Days 1 and 2, revisit 3 core ideas. Write down your goals and your risk tolerance. Sounds simple, right? But this is the most solid starting step you can take. Use these first 2 days to go back, not to reread the entire book or rewatch every video, but to focus on the 3 core ideas you feel are the most important to you, or the 3 concepts you're still the most unsure about. That might be the principle of buying as price breaks higher, the importance of cutting losses, or how to read trading volume. Really chew on these ideas, don't just skim them. Ask yourself, why is this important? How well do I actually understand it? How could I apply this in a real trade? And here's the equally important part. Write down your goals in the market and your personal risk tolerance. Grab a notebook or open a doc on your laptop, whatever feels natural for you. What is your goal? Do you want extra monthly income? Are you trying to grow a long-term nest egg, or do you simply want to challenge yourself in a new field? Be as specific as possible. For example, I want to earn an additional 10% per quarter on a starting capital of X. What is your risk tolerance? How much of your capital are you willing to risk on a single trade? Can you still sleep well if your account is down 5%, 10%, 20%? This isn't about how much you could lose in some extreme scenario. It's about how much you can emotionally and financially accept losing without it wrecking your personal life or your trading psychology. When I first started out, I skipped this step. And the result, every time the market got volatile, I panicked because I didn't have any kind of true north guiding me. Writing this down gives you a solid anchor both mentally and strategically. Treat this step seriously. Days 3 and 4, pick one sector you care about and find 3 leading stocks in that sector. Start watching their charts. Once you've built that foundation over the first 2 days, now it's time to start exploring the real world. Instead of diving into hundreds of random ticker symbols, start with one sector you genuinely care about. If you're a tech geek, look at tech. If you're into clean energy, start there. Choosing a sector you're actually interested in turns this into an exciting exploration, not a chore. Within that sector, identify 3 leading stocks. These are usually the biggest companies with strong market share, solid growth, or clear competitive advantages. You can find them using industry reports, reputable financial news sites, or stock screeners. Once you've picked your 3 names, pull up their charts. I recommend platforms like TradingView or any charting software you're comfortable with. Now, watch them daily. Don't try to predict where they'll go. Just observe. How do their prices move? What does their trading volume look like? Are they in uptrends or downtrends? When the overall market goes up, do they outperform? When the market pulls back, do they hold up better than most? Spend time getting used to the rhythm of these stocks. This builds your intuition and familiarity with price actions, a critical skill for any speculator. Days 5 and 6, open a paper trading account. Practice placing buy orders and stop losses for one of the stocks you picked. Now we're finally going to get our feet wet without risking a single real dollar. Paper trading is an incredibly valuable tool. It lets you practice placing orders, feel the pressure of market movement, and test out your ideas without any actual financial risk. Many brokers and charting platforms in the US, including TradingView and others, offer free simulated trading. Set up a paper trading account, then using one of the 3 leading stocks you picked, practice. 1. Or SMA. Placing a buy order. Let's say you spot a potential buy signal based on what you've learned. For example, the stock breaks above a key resistance level on high volume. Place a simulated buy order for a reasonable number of shares, say 100 shares at the breakout level. 2. Placing a stop-loss order. This is the most important part. Right after you buy, place a stop-loss order. Think back to everything we discussed about protecting capital. Your stop-loss should be at a price level that, if hit, tells you your trade was probably wrong and it's time to get out and limit the damage. Your goal for these 2 days is not to win this practice trade. Your goal is to get familiar with the process, navigating the platform, actually placing orders, feeling the difference between thinking about a trade and physically entering one. Most importantly, you're training yourself to always set a stop loss. This is a habit you want to build from day 1. Day 7, review your paper trade. Write your first journal entry. What did you learn? This is the final day of the 7-day plan, and honestly, it might be the most important. A lot of people skip this step, but this is where real growth happens. Open your paper trading account again. Take a look at your simulated trade and your stop loss. Ask yourself, how did the stock move after you entered? Did your stop loss get triggered? Or is the trade still working? How did you feel watching the price move? Nervous, excited, impatient. Now grab your notebook or open your trading journal doc. It's time to write your first journal entry. Include trade details, ticker symbol entry price, stop loss level, date and time. Why you took the trade. What did you see on the chart? What setup or signal did you think you were acting on? Your emotions. How did you feel when you entered? How did you feel as the price moved? Most important, what did you learn? What played out as expected? What didn't? What would you do differently next time? I can't overstate how important a trading journal is. It's not just a place to stash numbers. It's a record of your learning curve and your personal growth. Over time, it becomes living proof of your progress. It helps you see your own patterns, correct mistakes, adjust your strategy, and build a solid trading mindset. So we've now walked through your 7-day action plan. This is not some magic get-rich-quick formula. It's a structured roadmap to help you start applying what you've learned in a systematic way. By the end of these 7 days, you'll have a clearer foundation around your goals and risk tolerance. You'll have started exploring the market and watching how price moves. You'll have practiced placing orders and managing risk without fear. And most importantly, you'll have taken your first step into self-directed learning through a trading journal. Every step, no matter how small, is still progress. Don't worry if things don't feel perfect yet. The goal is to start to take action and to learn from your early experiences. Commit to yourself that you'll follow this 7-day plan seriously. I truly believe that after just 1 week, you'll feel much more confident and ready for the next stage of your journey toward becoming a successful speculator. Thank you for walking through this section with me. Don't forget to drop a comment and share how your 7-day experience goes. I'd love to hear about it. I'm really looking forward to seeing you in the next part, where we'll dive deeper into more specific strategies. We've gone through every chapter together, digging into each idea the author wanted to convey. But if I had to distill all the essence, the very soul of this book, into something you can carry with you, like a compass on your journey through the financial markets, I'd narrow it down to 3 golden keys. These aren't just rules. They are timeless principles, the kind every successful speculator lives by. Let's take our time and really reflect on each one. 1. Discipline is king. Emotion is the enemy. Trade by system, not by impulse. It sounds obvious, right? Yet, it's the hardest thing to practice consistently. The financial market at its core is a psychological battlefield. The fear of losing money, the greed when prices skyrocket, the frustration when a stock stalls for days. All these emotions are your most dangerous enemies, ready to destroy any trading plan you've carefully crafted. Do you recognize yourself in this? Have you ever created a detailed plan like, Okay, I'll buy this stock at X, cut my losses at Y, take profit at Z. But the moment the market dips and everything turns red, you panic and sell right at the bottom. Or the opposite when you see a stock suddenly exploding higher. Even though it doesn't meet any of your criteria, you still jump in because of FOMO, only to buy right at the top. That's what happens when emotion beats logic, when discipline gets thrown out the window. The author emphasized over and over again, you must have a clear, tested trading system. And more importantly, you must religiously follow it. Treat it like an aviation checklist. A pilot can't fly a plane based on gut feeling. He must follow procedures, read instruments, and base his decisions on data, even when the weather gets rough, even when his nerves shake. So take the time to build a strategy that fits you. Your psychology, your risk appetite, your financial goals. And once you have that system, wear discipline like armor. It will shield you from emotional storms and reckless decisions. Trade based on data, on signals, on rules, not on whispers of fear or greed echoing in your mind. Remember, discipline is the compass that keeps your ship steady through every wave. 2. Cut losses quickly. Let profits run. Your top priority is always capital protection. This is one of the golden principles repeated in every book, every course, every legendary trader's teaching. Yet countless traders, beginners and veterans alike, still fail at it. Human psychology is strange. We hold on to losing positions praying they'll bounce back. We say things like, it'll come back. I'll break even eventually. That single sentence has buried countless trading accounts. We hate the idea of locking in a small loss, even though it's manageable. But when it comes to profits, we rush to take them. Even tiny ones. Even when we know the stock still has room to run. This is the formula for failure, letting losses grow, taking profits too soon. The author reminds us, protecting your capital must be your number one priority. Your capital is your army. If you let your soldiers die in a losing battle, you won't have enough strength left when a real opportunity finally appears. Remember, the classic line, cutting losses is an art. It requires decisiveness, the acceptance that you were wrong, and the wisdom to know that taking a small loss now protects you from a catastrophic one later. It's like treating a small wound before it becomes an infection that spreads through your entire portfolio. On the flip side, when you have a winning position, let it run. Let the market do the work for you. A strong stock in a strong uptrend often continues higher. Your job is to be patient. Move your stop loss upward, a trailing stop to protect your gains, and only exit when there is a clear signal that the trend has reversed. Think about this. If you consistently cut losses quickly, say 5 to 7%, and let profits run, say 20, 30% or more, you don't need a high win rate. A minority of winning trades can still make you very profitable. Capital protection is your foundation, the lifeline of your entire trading career. 3. The market is always right. Listen to the trend, don't argue with it. This is the final key, and one that many new traders spend a painful amount of money learning. Our ego often tricks us into being stubborn. We think a stock should go up, but the market sends it down. We believe a sector must be strong, yet money keeps flowing out of it. And then we start arguing internally. The market is wrong. People don't understand the true value. Investors are being misled. But here's the truth. The market is never wrong. The market is the sum of millions of buy and sell decisions. It's the pure expression of supply and demand, of fear and optimism, of information, both visible and invisible. The market has no ego, no pride, no emotion. It simply is. Trying to fight it is like trying to swim against a raging current or trying to change the direction of the wind. You'll exhaust yourself and lose. The smart speculator's job is simple. Observe, listen, follow. Read what the market is telling you through price action, volume, and trend signals. Let the trend guide you. If the market is in an uptrend, look for buying opportunities. If it's in a downtrend, stay out or consider short setups if that's part of your system. Don't try to buy the bottom during a market crash, and don't try to call the top during a euphoric rally unless you have a very strict system for it. The author shows us that the biggest profits come from riding a strong trend, not fighting it. Be like a skilled surfer. Catch the wave and ride it. Don't fight the ocean. Let go of ego. Let go of personal bias. Let the market lead the way. So there you have it, my friends. The 3 golden keys. Discipline is king. Capital protection comes first. The market is always right. These aren't just tips from a book. They are time-tested principles, proven over decades, forming the foundation of every sustainable success in the financial markets. Carry these 3 keys with you. Reflect on them deeply. Make them part of your trading mindset and your trading habits. I'm confident that if you truly internalize and apply them consistently, your path in the financial markets will become far clearer, far steadier, and far more rewarding. And just like that, we've reached the final pages, or rather, the final lessons of this classic book, Successful Stock Speculation. I know you might be feeling like you've just been equipped with a whole new arsenal of knowledge, from the most fundamental principles to the sophisticated strategies used by successful speculators. But you know what? This isn't the end. This is the beginning, a fresh, promising starting point for your own journey. To me, every great book and every valuable insight only becomes truly powerful when we turn it into action, into our own lived experience. It's like reading a book about swimming. No matter how well you understand the techniques, you'll never become a good swimmer unless you actually get in the water, right? So now that we've walked through all these ideas together, what has really stayed with you? Which lesson from successful stock speculation resonated with you the most? Was there a part that made you stop, think, and suddenly realize, so that's what I've been missing, because it struck right at a weakness or a question you've had for a long time? I'd genuinely love to hear your story, and I know our community would too. Sometimes a single question or insight from you can spark a new idea or create a breakthrough moment for someone else following along. So please don't hesitate. Share your thoughts and reflections down in the comments. We grow by learning from one another. If you found this video helpful, if anything I shared brought you real value, even a little, then don't forget to hit that like button. It's a huge source of motivation and tells me that this content is meaningful to you, so I can keep creating even better videos in the future. And if you haven't subscribed yet, now is the perfect moment, so you won't miss any of the deep dive market analyses, investment mindset breakdowns, or classic book dissections we'll explore together in the coming weeks. Remember to hit the notification bell too, so you'll know the moment a new video goes live. Trust me, you won't want to miss it. Now that you've absorbed the strategies and mindset lessons from successful stock speculation, you might want to dig deeper into another incredibly important side of the market psychology. Crowd psychology can be a double-edged sword, both an opportunity and a trap. I've already created a detailed video called Understanding Market Crowd Psychology, Master Your Emotions, Master the Game, where I break down how emotions manipulate investor decisions and how you can stay grounded when everything around you feels chaotic. You'll find the link right on the screen with the thumbnail for Fan Teach Tam Li Jam Jong, or in the video description. I truly believe it will add a crucial missing piece to the big picture you're building about the market. And to help turn all this theory into practical tools you can use on your trading journey, I've prepared a special bonus for those of you who stayed with me all the way to the end. That includes a professional trading journal template so you can record and analyze every trade with structure and clarity, or a 10-point checklist before buying any stock, a list of key criteria that will help you make smarter, lower-risk decisions. These tools will help you stay disciplined, evaluate your performance more clearly, and most importantly, learn from every experience. You can download them completely free by clicking the link in the description or scanning the QR code on the screen. Use them. I promise they'll make a real difference. They're exactly the kind of tools I wish I had when I first started. The world of investing is a lifelong journey of learning and adapting. Remember, every small step, every lesson applied brings you closer to your goals. Don't be afraid to experiment. Don't be afraid to make mistakes. What matters most is what you learn from them. I'm truly grateful to be walking this journey with you. Start your path right now with the knowledge you've gained and the tools we've prepared. I believe in you. Thank you for watching, and I'll see you in the next video. Wishing you clarity, confidence, and smart decisions on your investing journey.